Many business owners get their financial reports back from their external accountants with profits much lower than what their internal report showed. Why is that? One of the reasons is that depreciation wasn't recorded on the internal reports. For many business owners, the depreciation number on their income statement is a mystery. Sometimes the explanation they get just flies over their head, and they don't understand how they can come up with that number. Sometimes there are changes to the tax system that has an impact on some companies in a way that the owner doesn't realize. In this video, I will explain depreciation so that you better understand it. But first, let me explain why business owners are surprised by the lower profits. One of the reasons that profits are a lot less on the financial reports prepared by the external accountants than what the internal report showed is that depreciation is not recorded on the company's internal statements. Often, your bookkeeper waits to get the entry for depreciation from the external accountant. Why is that? One of the reasons is that the bookkeeper doesn't know how to calculate the entries. Another reason is that internal accountants sometimes make the depreciation the same as it is calculated for the company's tax return. And when the rules for tax depreciation change, the bookkeeper would have to know what those changes are to properly record the depreciation. When there are purchases and dispositions of assets, this can make it even more complicated. Sometimes, business owners see their depreciation expense go up significantly. One of my clients saw their depreciation expense go up so much that it created a significant loss, where they couldn't get a new loan from the bank. Why is that? For the benefit of businesses, the government sometimes introduces incentives that allow corporations to write off the full cost of certain vehicles and equipment in the year that they were purchased for tax purposes. This is a good thing, because it allows these corporations to pay less tax in the year of the purchase. What does this have to do with depreciation on the financial report produced by your accountant? Well, for some, you may see in the notes at the back of the prepared financial reports the following: property, plant, and equipment amortized on the same basis as for income tax. I didn't see a problem with using this policy when the normal tax method more closely reflected the estimated life of the assets being depreciated. However, I do have a problem with this policy when it does not reflect the asset's useful life and causes the profitability of the company to be much lower than it would otherwise be, impacting their relationship with their financial institutions. If this happened to you, I suggest that you talk with your external accountant about setting up a depreciation policy that more closely reflects the useful life of the assets. There is absolutely no problem with having a depreciation policy for the financial report that is different than what is used on the company's tax return. Now, I'll explain depreciation. There is an accounting principle that is used by accountants called the matching principle. The idea of the matching principle is to match revenues with the expenses that were incurred to generate those revenues. The matching principle also relates to matching expenses to the correct time period that those expenses relate to. What does that have to do with depreciation? If your company purchases a dump truck, you expect that that vehicle will work for your business for a number of years and help generate revenue for your business over that time. In that case, it wouldn't be right to expense the purchase price of the dump truck in the year you purchase it. Instead, that purchase price should be expensed over the years that it will generate revenue for the business, thus matching the expense with the generated revenue. This is where depreciation helps to use the matching principle. Let's say that you purchase a dump truck for $50,000, and the useful life of that truck is expected to be 5 years. I know this isn't realistic, but stick with me on this. If you use the straight line method of depreciation, you will divide the $50,000 by 5 years to get a depreciation expense of $10,000 a year for 5 years. At the end of 5 years, that dump truck will have zero value on the company's balance sheet. Here you can see the impact on the income statement and the balance sheet in each of the 5 years. You say, wait a minute, even a 5-year-old dump truck that has been used a lot still has value at the end of the 5 years. Even if I bought it, let's say that you plan to sell that dump truck after 5 years. You could still use the straight line method with a residual value at the end. Let's say that the residual value is $15,000. You would take the $50,000 purchase value less the $15,000 residual value to get $35,000. Then dividing that by 5 years would give you a depreciation expense of $7,000 a year. Here you can see the impact on the income statement and the balance sheet each year with the book value of $15,000 at the end of the 5th year. Now, what if you say that the repairs and maintenance costs are very low at the beginning, but are much higher as the truck gets older, and the truck really depreciates more at the beginning of its life than it does at the end? With that in mind, maybe the declining balance method makes more sense. Here we depreciate 20% of the declining net book value of the truck each year. In the first year, it is the same as the straight line depreciation method without a residual value at $10,000, which is 20% of $50,000. After the first year, the amount depreciated is less and less. In the second year, we calculate the depreciation by multiplying $40,000 times 20% to get $8,000, and so on. You can also see that there is a net book value of the truck of $16,384 at the end of 5 years. It will never go to zero because it goes down by a percentage of the net book value. Another method of depreciation is based on the units produced, the hours used, or the mileage driven. This isn't used very often, but it may make sense to use in certain circumstances. There is another twist to calculating depreciation, and under normal circumstances, this rule is used by Canada Revenue Agency in calculating depreciation, or what they call capital cost allowance, or CCA. That rule is called the half-year rule. It assumes that the newly purchased asset will not be in use for the entire fiscal year, and thus only half of the normal depreciation would be expensed in the first year of owning that asset. If we use the same declining balance example, this is what it would look like. Instead of $10,000 depreciation expense in the first year, it would be half of that, or $5,000. If you remember, without the half-year rule, the net book value at the end of the 5th year was $16,384. With the half-year rule, the net book value is now $18,432 at the end of the 5th year. You may say that there are some assets that go up in value over time. That is correct. Buildings often go up in value. You might then ask, why doesn't this increase in value get reflected on the company's balance sheet? That is because accounting is based on the historic cost basis and not the fair market value, while these assets haven't changed ownership. This is because the historic cost is considered more reliable and objective than market value. And there is a conservatism principle in accounting that says that potential gains are not recognized until they are realized. It also allows for easier comparison of financial statements over time and more stability in reporting. Now let's consider what would happen when you sell that building after a number of years and that building has gone up in value from what you had paid for it. You will now look at an example assuming we depreciated it using a declining balance depreciation method with a half-year rule. Here we would use a lower percentage than we would for a dump truck. Let's use 4%. You can see that the depreciation in the first year is $20,000, which I get by multiplying $1 million by 4% and then dividing by 2 to get $20,000. We go forward 10 years and we can see that the net book value of the building at the end of 10 years is $678,700. Now let's say that in year 11 we sell the building for $2 million. There would be a gain on the sale of the building of $1,321,300 because we take the selling price of $2 million less the net book value of $678,700. This is how we would work on the financial reports of the company. For tax purposes, the gain of $1,321,300 would be split. The $321,300 that was depreciated over the 10 years is considered recaptured depreciation. The difference between the selling price and the cost of the building is considered a capital gain, which works out to be $1 million in our example. Capital gains are taxed more favorably than recaptured depreciation. We've covered a lot, and I sincerely hope that you have a much better understanding of depreciation and why you may be getting surprised by lower profits on your financial reports provided by your external accountant. Thank you for watching. If you found this video useful, please like it. You may also consider subscribing to this channel so that you will know when I upload new videos. I believe that all business owners should have a good understanding of finance, and it is my goal with this channel to help business owners to do just that. If you have any questions or need some help with improving your business, please email me at kevin@copiousInsights.com. Bye for now.